Well, good morning, everybody. I'm very pleased to be here again. When I say again, 1 year on from our Beyond the Crunch conference. And I thought, in terms of setting the scene and seeing the setup in this role, it might be useful, just very, very briefly, to refresh our memories on the world in which we operated and which we enjoyed regeneration and development before the crisis struck, the old realities, if you like. There was economic growth. In fact, there was 15 years of continuous economic growth up to 1997 in that nice decade and a half of non-inflationary continuous expansion. We were afloat on a sea of plentiful, cheap debt. There was growth in public spending, and from 2000 onwards there was very strong growth in public spending. There was rising land and property values. There was a very active, increasingly active, development market in which substantial contributions were possible to the funding of infrastructure, affordable housing, new swimming pools, and other things that came under the category of planning gain. Mixed use, remember that? The planner's favourite, whether the market wanted it or not. And buoyant demand sectors across the market: retail, leisure, tourism, financial services, of course, and also the public sector itself, expanding universities, NHS, how many offices were let to primary healthcare trust, local authorities, and a bewildering and growing range of quangos. And in the housing sector, a boom in city centre apartments wanted, it seemed, by everyone everywhere, particularly investors in Singapore. Those were the old realities, and I'd like you to just bear those in mind as we look ahead and try and see dimly what the new realities we now face are. So, on the economic outlook, comment has already been made as to where we were a year ago and where we may have come from since then. A year ago, the economy, indeed the financial system, had just narrowly escaped a near-death experience. It seemed, was definitely in intensive care, receiving massive, as it happened, economically medical stimuli in the shape of interest rates being dropped to near zero, the beginning of quantitative easing, and substantial fiscal stimulus. In the course of the past 12 months, it seemed that slowly the economy has been able to sit up in bed and take a glass of water, and maybe, on the basis of the latest statistics, is now out and strolling around the hospital corridors, still with the aid, though, of the substantial crutches of rock-bottom base rates and £200 billion of asset purchases by the Bank of England and a massive public sector deficit. And the question now, of course, is when and how strongly is it going to be able to proceed as and when those crutches have to be taken away, which is the key issue, I think, in the outlook for both policy and the economy at the moment. Well, if we compare what's happened in this downturn with the last couple of significant recessions that the UK endured, you can see that this one has been a very, very serious affair. The cumulative fall in output much more severe than in the early 1990s, which caused so much damage to the property market. And in fact a little bit more severe even than the recession of the early 1980s. The latest indicators suggest now that we have at least reached some form of stability, a bottoming out, first signs of positive growth coming through in the fourth quarter of last year. But also, as you can see from this chart, I think there is a lesson from history, is that if this is the bottom and from here we are heading upwards, then if it's anything like the experience in the 1980s, it's not a simple smooth progression, a nice glide upwards. There will be steps and stumbles along the way. And that also, it takes a very long time from this sort of depth of hole to climb out and get back to the level of economic activity that the economy sustained before it fell into the hole. And that indeed is the view of most economic forecasters at the moment, and indeed of the Bank of England. Now, there's plenty of economic forecasts around. I like this one and use it quite regularly because it emphasises, I think, the terrific uncertainty that still surrounds the prospects for the UK economy, which the Bank of England, in its presentation of fan charts, makes very explicit. The bank expects from here that the path of economic activity will be upwards, but with quite a wide spread of possibilities as to how strongly or how quickly it will rise upwards. Not only that, but according to the Bank of England, we are not too sure about where the economy may be going. Equally, we don't seem to be too sure about where it's just been either, which further adds to the uncertainties surrounding us. So the general view is that, yes, we probably have bottomed, and there will be economic growth from here, not necessarily continuous and not necessarily smooth. But perhaps more importantly is the character and the constraints that will, of that growth and the constraints that will weigh on it. And in that particular respect, the theme is clearly the legacy of debt that is now overhanging the economy. First, debt in the household sector. One of the trends over the past decade up to 2007, as you can see from this chart, was a very, very large rise in the ratio of debt in the household sector to personal disposable income. It rose from about 100% to 160% in 2007. The taking on of debt grew twice as fast as incomes in that period. Why? That was not principally due to an explosion of credit card borrowing. It was due to a hugely increased mortgage debt that households took on in that period of rapidly inflating house prices. And over the same period, as you can see, there was a very sharp fall in the savings ratio. Now that has now started to reverse. The savings ratio is rising and the level of household debt to income is levelling out. But at 160% of income, that is a pretty heavy level, a pretty heavy burden of leverage, gearing, overhanging the household sector, which is going to weigh on spending going forward. I do not need to dwell on the other aspect of debt, which is now overhanging and weighing on the economy, which is the explosion in public sector borrowing to over 170 billion this year, probably similar going forward, the massive expansion in the size of the total public sector debt, and the fact that this is now the dominant issue for policy, and will be in the election going forward, how fast, how quickly, and in what ways this deficit will be reduced. And if I hear any more about tough decisions will need to be made going forward, I think I may mentally implode. We're going to hear a lot more of that up to the election. But the key issue that this leaves us with is basically that the amount of household debt and the need to reduce the deficit, however fast and in whatever ways that happens, is going to weigh on the consumer side of the economy going forward and on the rate of growth of spending. There are a variety of forecasts about this, but this particular chart, which I don't necessarily go with, is the forecast from Experian Business Strategies, showing their expectations of the likely growth from here, of real household spending and indeed in retail sales volumes, which shows actually that last year retail spending held up remarkably well in a situation where consumer spending was contracting, helped by the VAT cut and so forth, but pretty modest growth if expected going forward. Very little this year and then barely 2% for the next 2 to 3 years per annum in household spending, and retail sales are really showing no acceleration over their recent rate of expansion, and certainly not getting back to anything like the rates of growth that were experienced earlier in the decade. So I think this is an important theme for the economy going forward, a subdued outlook in the consumer sector.